Question 1. Which of the following is an example of a non-proportional reinsurance arrangement? A. Surplus share treaty. B. Excessive loss treaty. C. Quota share treaty. D. Facultative reinsurance. Answer B. Excessive loss treaty. Explanation: non-proportional reinsurance refers to arrangements where the reinsurer's liability is triggered once the insurer's losses exceed a certain threshold. The excessive loss treaty is a key example of this. In this arrangement, the reinsurer only pays when losses exceed a predetermined retention limit. This differs from proportional reinsurance, such as quota share or surplus share treaties where the reinsurer shares a fixed percentage of both premiums and losses. Facultative reinsurance is a case-by-case arrangement for individual policies rather than a treaty structure. Question 2. Mr. Davis is a reinsurer who has entered into a facultative reinsurance agreement with an insurer, ABC Insurance. ABC Insurance has sent a policy for a high-value property, and the coverage exceeds their retention limits. According to the facultative agreement, Mr. Davis must assess the policy on a case-by-case basis before deciding to accept it. What should Mr. Davis do? A. Automatically accept the policy as the insurer's coverage exceeds retention limits. B. Reject the policy outright as it does not meet the agreed-upon underwriting guidelines. C. Assess the policy based on its individual risks, review any exclusions, and then decide whether to accept it. D. Direct ABC Insurance to place the policy with another reinsurer without reviewing it. Answer C. Assess the policy based on its individual risks, review any exclusions, and then decide whether to accept it. Explanation: facultative reinsurance allows the reinsurer to evaluate and decide whether to accept individual risks that exceed the retention limits of the primary insurer. Mr. Davis must assess the specific terms, risks, and potential exclusions of the policy on a case-by-case basis before making a decision. This is the feature of facultative reinsurance, which differs from treaty reinsurance, where all policies within a defined group are automatically covered. The other options do not align with the facultative approach of individual risk evaluation. Question 3. Which of the following is a key characteristic of retroactive reinsurance? A. It covers future losses and claims based on current policies. B. It involves the transfer of liabilities for losses that have already occurred. C. It only applies to losses occurring in the coming policy year. D. It is used exclusively for non-proportional treaties. Answer B. It involves the transfer of liabilities for losses that have already occurred. Explanation: retroactive reinsurance is designed to cover past losses, typically for liabilities that have already been incurred but not yet settled. This type of reinsurance can be used to manage claims that have arisen in previous years. It contrasts with traditional reinsurance, which focuses on future risks. The other options are incorrect because retro reinsurance is not for future losses, nor is it confined to specific types of treaties such as non-proportional arrangements. Additionally, it does not focus solely on the coming policy year. Question 4. Which of the following is typically covered under a proportional reinsurance agreement? A. Catastrophic losses that exceed a specific threshold. B. Losses that are shared based on a fixed percentage between the insurer and reinsurer. C. Only the excess losses above the primary insurer's retention. D. The liability for individual policies on case-by-case basis. Answer B. Losses that are shared based on a fixed percentage between the insurer and reinsurer. Explanation: proportional reinsurance, such as quota share or surplus share treaties, involves the reinsurer sharing a fixed percentage of both premiums and losses. This agreement is defined by a set percentage which both parties agree upon. In contrast, non-proportional reinsurance, e.g. excessive loss treaties, covers losses above a specified threshold, while facultative reinsurance focuses on individual policies rather than a fixed percentage. Question 5. Which of the following is a key factor when calculating reinsurance premiums in a proportional reinsurance arrangement? A. Loss ratio and expense ratio calculations. B. Projected claims for the upcoming year. C. The current rate of inflation in the primary insurer's region. D. Credit ratings of the insurer. Answer A. Loss ratio and expense ratio calculations. Explanation: when determining reinsurance premiums, The reinsurer often considers the loss ratio, claims paid divided by premiums earned, and the expense ratio, operational expenses divided by earned premiums. These ratios help the reinsurer assess the potential risk of the insurance portfolio. Premium calculations in proportional reinsurance are based on shared losses, premiums, rather than future projected claims or inflation. The credit ratings of the insurer are considered in financial solvency assessments, but they are not typically the primary factor in determining premiums for proportional reinsurance. Question 6. Under Maryland law, a reinsurer must meet which of the following requirements to ensure financial solvency? A. Maintaining a minimum capital requirement as prescribed by the Maryland Insurance Code. B. Holding a specified percentage of total premiums in cash reserves. C. Demonstrating profitability over the last 5 consecutive years. D. Reinsuring a portion of its own liabilities to offset potential risks. Answer A. Maintaining a minimum capital requirement as prescribed by the Maryland Insurance Code. Explanation. According to the Maryland Insurance Code, reinsurers must maintain a certain level of capital to ensure their financial solvency. This capital requirement is designed to protect policyholders and the broader financial system in the event of large claims. The other options are not specifically required under Maryland's solvency regulations. Reinsurers. The primary focus of the regulatory framework is on maintaining sufficient capital rather than profitability or reinsuring portions of their own liabilities. Question 7. Which of the following is a common feature of an aggregate excessive loss reinsurance arrangement? A. The reinsurer's liability is capped after single large loss. B. The reinsurer assumes liability for all claims above set threshold for specified period. C. The insurer and reinsurer share fixed percentage of each individual claim. D. The reinsurer provides coverage for losses incurred in the following year only. Answer B. The reinsurer assumes liability for all claims above a set threshold for a specified period. Explanation. An aggregate excessive loss reinsurance arrangement provides coverage for cumulative losses that exceed a predetermined threshold within a specified period, typically a year. This arrangement protects the primary insurer from large aggregate losses across multiple claims, and like individual excessive loss treaties, which single large losses, it does not involve the sharing of individual claims or provide coverage for future years. Question 8. Which of the following is not a responsibility of the Maryland Department of Insurance, DOI, with regard to reinsurance oversight? A. Ensuring that reinsurers maintain sufficient financial solvency. B. Setting the rates for reinsurance premiums in the state. C. Regulating the terms and conditions of reinsurance contracts. D. Monitoring the reinsurance market for stability and risk exposure. Answer B. Setting the rates for reinsurance premiums in the state. Explanation. The Maryland Department of Insurance, DOI, does not set reinsurance premium rates, as these are generally determined by market conditions and negotiations between insurers and reinsurers. However, the DOI does play a critical role in overseeing financial solvency, regulating contract terms and conditions, and monitoring the reinsurance market for risks. Stability. The DOI ensures that reinsurers meet the regulatory requirements for capital and solvency, but it does not intervene in setting specific premium rates. Question 9. Which of the following best describes the role of reinsurance in managing catastrophic risk? A. Reinsurance only provides coverage for small, frequent losses. B. Reinsurance spreads the risk of catastrophic events across multiple insurers and reinsurers. C. Reinsurers solely provide excess coverage for non-catastrophic losses. D. Reinsurance limits the exposure to claims in the first year of a policy. Answer B. Reinsurance spreads the risk of catastrophic events across multiple insurers and reinsurers. Explanation. Reinsurance is a vital tool for managing catastrophic risk by spreading large and frequent losses across multiple parties. This allows insurers to mitigate their exposure to highly unpredictable and high-severity events such as natural disasters. The other options do not accurately reflect the primary role of reinsurance. Managing catastrophic risk. Reinsurers do not focus on small or non-catastrophic losses, nor do they limit claims exposure in the first year of coverage. Question 10. Which of the following clauses is commonly included in reinsurance contracts to resolve disputes between the primary insurer and the reinsurer? A. Choice of law provision. B. Arbitration clause. C. Retroactive coverage clause. D. Claims payment clause. Answer B. Arbitration clause. Explanation. Arbitration clauses are commonly included in reinsurance contracts to provide a clear method for resolving disputes between the primary insurer and the reinsurer. Arbitration allows for a neutral third party to make binding decisions, which can expedite dispute resolution compared to traditional litigation. The choice of law provision specifies which jurisdiction's laws will govern the contract, while the retroactive coverage clause applies to specific types of reinsurance, and the claims payment clause addresses how claims are paid. However, the arbitration clause is specifically designed for resolving disputes. Question 11. Which of the following is true regarding the difference between facultative and treaty reinsurance? A. Facultative reinsurance is used for individual risks, while treaty reinsurance covers a portfolio of risks. B. Facultative reinsurance automatically applies to all policies in a treaty, while treaty reinsurance only applies to specific risks. C. Facultative reinsurance is always non-proportional, while treaty reinsurance is always proportional. D. Facultative reinsurance is more common in larger insurance compared to treaty reinsurance. Answer A. Facultative reinsurance is used for individual risks, while treaty reinsurance covers a portfolio of risks. Explanation. Facultative reinsurance is negotiated on a case-by-case basis for individual risks, whereas treaty reinsurance covers a portfolio of risks automatically under a predefined agreement. This makes facultative reinsurance more specific and selective, whereas treaty reinsurance provides coverage for all risks within the scope of the agreement. The other statements are incorrect, as facultative reinsurance is not necessarily non-proportional, and treaty reinsurance does not automatically apply to individual policies within a facultative arrangement. Question 12. In Maryland, which of the following is true regarding the financial solvency of reinsurers? A. Reinsurers must submit their financial reports only if they are requested by the Maryland Department of Insurance. B. Reinsurers are required to meet solvency standards through risk-based capita (RBC) requirements set by the Maryland DOI. C. Maryland law allows reinsurers to operate without submitting financial solvency reports if they are part of a reinsurance pool. D. Reinsurers must only demonstrate profitability, not solvency, to operate within Maryland. Answer. B. Reinsurers are required to meet solvency standards through risk-based capita (RBC) requirements set by the Maryland DOI. Explanation. Maryland requires reinsurers to maintain adequate risk-based capital (RBC) levels to ensure they can meet their obligations. This capital requirement is calculated based on the level of risk that the reinsurer undertakes. This ensures that reinsurers have enough financial resources to cover claims. The other options are incorrect because solvency reports are mandatory and profitability alone does not determine solvency in Maryland. Question 13. Which of the following is true about retroactive reinsurance? A. Retroactive reinsurance covers losses that have already occurred but not yet reported. B. Retroactive reinsurance is used primarily for natural disasters. C. Retroactive reinsurance only applies to policies that are still active. D. Retroactive reinsurance cannot be used in facultative arrangements. Answer A. Retroactive reinsurance covers losses that have already occurred but not yet reported. Explanation. Retroactive reinsurance is a type of reinsurance that covers losses that have occurred in the past but have not yet been reported. This type of reinsurance is typically used to manage large liabilities that have already been incurred, such as for long-tail claims. It does not apply exclusively to natural disasters or active policies. Retroactive reinsurance can be used in both facultative and treaty arrangements, depending on the situation. Question 14. Which of the following is typically not a component of a reinsurance contract? A. Scope of coverage. B. Claims payment provisions. C. Discount rates for premiums. D. Limits and deductibles. Answer. C. Discount rates for premiums. Explanation. Reinsurance contracts typically include terms related to the scope of coverage, claims payment provisions, and limits and deductibles, which define the conditions under which claims will be paid and how coverage is applied. Discount rates for premiums are not typically a component of the contract itself, but may be negotiated separately between the reinsurer and the ceding insurer. These are more focused on how risks are transferred and the mechanisms for paying claims. Question 15. In the context of reinsurance, what does the term commutation refer to? A. The process of selling all claims payments before the treaty is concluded. B. A mutual agreement to terminate or adjust a reinsurance contract before its scheduled termination. C. The reinsurer's process of analyzing the ceding insurer's claims history. D. The reinsurance process for covering specific catastrophic events. Answer: B. A mutual agreement to terminate or adjust a reinsurance contract before its scheduled termination. Explanation: commutation refers to the agreement between the ceding insurer and the reinsurer to terminate or adjust a reinsurance contract before its expected end. This is often done to close out the financial obligations between the parties, either due to changes in business strategy, market conditions, or other factors, as not refer to settling claims or analyzing claims history. Question 16. Which of the following describes the primary function of reinsurance in a risk management strategy? A. To guarantee the solvency of the ceding insurer. B. To diversify and spread risks across multiple entities, reducing the financial burden on a single insurer. C. To eliminate the risk for the ceding insurer by transferring all liabilities. D. To reduce the need for insurance policies and coverage. Answer: B. To diversify and spread risks across multiple entities, reducing the financial burden on a single insurer. Explanation: the primary function of reinsurance is to help insurers manage their risk by diversifying and spreading risk across multiple parties. This helps protect insurers from large unexpected losses. Reinsurance does not eliminate risk entirely, as the insurer still retains some portion of the risk. It also does not the need for insurance policies, but rather helps manage large exposures. Question 17. Which of the following is an example of a non-proportional reinsurance arrangement? A. Quota share reinsurance. B. Surplus share reinsurance. C. Excessive loss reinsurance. D. Facultative reinsurance. Answer: C. Excessive loss reinsurance. Explanation: excessive loss reinsurance is a non-proportional reinsurance arrangement where the reinsurer covers losses above a specified threshold, usually after the primary insurer has paid a certain amount of losses. This is in contrast to proportional reinsurance, such as quota share or surplus share, where the reinsurer assumes a fixed percentage of both premiums and losses. Question 18. Which of the following is an essential element of reinsurance pricing? A. The ceding insurer's financial status. B. The reinsurer's credit rating. C. The loss ratio and claims frequency. D. The regulatory authority's approval of premium rates. Answer: C. The loss ratio and claims frequency. Explanation: when pricing reinsurance, the reinsurer assesses the loss ratio claims paid divided by premiums earned and the frequency of claims to determine the level of risk. This helps the reinsurer set a premium that reflects the anticipated claims costs. While the ceding insurer's financial status and the reinsurer's credit rating may influence the decision-making process, they are not primary elements used in pricing. Question 19. Which of the following is a feature of an aggregate excessive loss reinsurance arrangement? A. It covers individual losses above a predetermined threshold. B. It provides protection for cumulative losses exceeding a threshold over a specific period. C. It shares risk on a proportional basis between the insurer and reinsurer. D. It exclusively covers natural disaster-related claims. Answer: B. It provides protection for cumulative losses exceeding a threshold over a specific period. Explanation: aggregate excessive loss reinsurance covers the total amount of losses that exceed a specified threshold over a given period, typically a year. This form of reinsurance protects the ceding insurer from large accumulations of losses. It is not focused on individual claims or specific types of losses such as natural disasters. Question 20. Which of the following actions should an insurer take if a reinsurer is unwilling to pay a claim under a reinsurance agreement? A. Immediately sue the reinsurer in court. B. Pursue dispute resolution through the arbitration process specified in the reinsurance contract. C. Reduce the premium payments to the reinsurer. D. Cancel the reinsurance agreement with immediate effect. Answer: B. Pursue dispute resolution through the arbitration process specified in the reinsurance contract. Explanation: most reinsurance contracts include an arbitration clause, which specifies the process for resolving disputes, including payment issues. This is a quicker, more cost-effective method than litigation. Directly suing the reinsurer or cancelling the agreement may be more disruptive and is not typically the first step under the dispute resolution process. Question 21. Which of the following is not typically covered under an excessive loss reinsurance arrangement? A. Individual catastrophic claims that exceed the insurer's retention limit. B. Cumulative losses across multiple claims exceeding set threshold over period. C. Losses above set limit for particular risk or peril. D. Fixed percentage of all claims within specific portfolio of risks. Answer D. A fixed percentage of all claims within a specific portfolio of risks. Explanation: excessive loss reinsurance is focused on covering large individual claims or cumulative losses exceeding a certain threshold. It does not involve sharing a fixed percentage of all claims within a portfolio, which is characteristic of proportional reinsurance arrangements, such as quota share or surplus share reinsurance. Question 22. What is the primary difference between proportional and non-proportional reinsurance? A. Proportional reinsurance covers losses that exceed a set threshold, while non-proportional reinsurance covers all losses. B. In proportional reinsurance, the reinsurer shares a fixed percentage of premiums and losses, while non-proportional reinsurance covers losses above a specified limit. C. Proportional reinsurance involves facultative agreements, while non-proportional reinsurance is always treaty-based. D. Non-propor reinsurance is only applicable for large insurers, while proportional reinsurance applies to small insurers. Answer B. In proportional reinsurance, the reinsurer shares a fixed percentage of premiums and losses, while non-proportional reinsurance covers losses above a specified limit. Explanation: proportional reinsurance involves a fixed percentage of premiums and losses being shared between the ceding insurer and the reinsurer. Non-proportional reinsurance, such as excessive loss, only covers losses that exceed a predefined threshold, with the reinsurer covering the loss above that limit. The other options are incorrect, as they confuse aspects of facultative versus treaty reinsurance and the applicability of reinsurance based on insurer size. Question 23. What is the role of sliding scale commission in reinsurance pricing? A. It adjusts the reinsurer's commission based on the ceding insurer's profitability. B. It provides fixed commission rate to the reinsurer regardless of the loss ratio. C. It limits the reinsurer's liability in case of catastrophic losses. D. It allows the reinsurer to modify premium rates after the contract is signed. Answer A. It adjusts the reinsurer's commission based on the ceding insurer's profitability. Explanation: sliding scale commission is variable commission structure that adjusts based on the ceding insurer's loss ratio. If the insurer experiences fewer claims, lower loss ratio, the reinsurer pays higher commission. Conversely, if the insurer has high loss ratio, the commission paid by the reinsurer is lower. This structure incentivizes profitability control for the ceding insurer. Question 24. In which type of reinsurance does the reinsurer agree to cover all claims above a specified retention limit regardless of the number of claims? A. Facultative reinsurance. B. Surplus share reinsurance. C. Excessive loss reinsurance. D. Quota share reinsurance. Answer C. Excessive loss reinsurance. Explanation: excessive loss reinsurance covers claims that exceed a predetermined retention limit. The reinsurer takes on responsibility for losses above this threshold regardless of the number of claims. This arrangement helps protect insurers from large individual or cumulative losses. Facultative, surplus share, and quoted share reinsurance involve different methods of risk sharing. Question 25. Which of the following best describes finite risk reinsurance? A. It transfers unlimited risk to the reinsurer for an indefinite period. B. It limits both the reinsurer's liability and the insurer's recoverable amounts. C. It only covers risks related to natural disasters. D. It eliminates the need for regulatory compliance in reinsurance contracts. Answer B. It limits both the reinsurer's liability and the insurer's recoverable amounts. Explanation: finite risk reinsurance is a structured arrangement where both the reinsurer's liability and the insurer's recoverable amounts are capped. It is designed to manage financial risk and stabilize earnings rather than provide traditional risk transfer. It typically includes profit-sharing arrangements and is used for specific financial management purposes. Question 26. Which of the following is a key consideration when selecting a reinsurer? A. The reinsurer's location. B. The reinsurer's reputation and financial strength. C. The reinsurer's willingness to reduce premiums. D. The reinsurer's marketing strategies. Answer B. The reinsurer's reputation and financial strength. Explanation: An insurer must carefully consider reinsurer's reputation and financial strength to ensure the reinsurer can meet its obligations when claims arise. Financial stability is critical in reinsurance, as the reinsurer must have sufficient reserves to pay large claims. Other factors, such as location and marketing strategies, are less relevant to the core purpose of reinsurance. Question 27. What is the primary purpose of stop-loss reinsurance? A. To cover individual claims above a specific threshold. B. To protect the insurer against catastrophic events. C. To limit the insurer's total losses within specified period. D. To transfer all risks to the reinsurer. Answer: C. To limit the insurer's total losses within specified period. Explanation: stop-loss reinsurance is a type of excessive loss coverage that limits the insurer's total losses over a defined period, typically a year. It provides protection when the insurer's aggregate losses exceed certain threshold. This type of reinsurance helps insurers manage overall risk exposure and protect against unexpectedly high loss levels. Question 28. Which of the following statements about proportional reinsurance is correct? A. The reinsurer covers only catastrophic losses. B. The reinsurer receives a percentage of premiums and pays the same percentage of losses. C. The reinsurer's liability is capped at predetermined amount. D. The reinsurer does not participate in the premium earnings. Answer: B. The reinsurer receives a percentage of premiums and pays the same percentage of losses. Explanation: in proportional reinsurance, the reinsurer shares a fixed percentage of both the premiums and the claims with the ceding insurer. This arrangement ensures that the reinsurer participates in both the risks and rewards of the insurance portfolio. The reinsurer's liability is proportional to the premium it receives. Question 29. Which of the following is an advantage of facultative reinsurance? A. It automatically covers all policies issued by the insurer. B. It is less expensive than treaty reinsurance. C. It allows the reinsurer to evaluate and accept or reject specific risks. D. It eliminates the need for regulatory approval. Answer: C. It allows the reinsurer to evaluate and accept or reject specific risks. Explanation: facultative reinsurance is arranged on a case-by-case basis, allowing the reinsurer to assess specific risks before accepting them. This provides flexibility to both the ceding insurer and the reinsurer. However, it is typically more time-consuming and expensive than treaty reinsurance, which covers a portfolio of risks automatically. Question 30. What is a ceding commission in reinsurance? A commission paid by the reinsurer to the ceding insurer to cover administrative expenses. B. A fee paid by the ceding insurer to the reinsurer for risk transfer. C. A penalty fee charged by regulators for non-compliance. D. A bonus paid to the reinsurer for profitable underwriting. Answer: A. A commission paid by the reinsurer to the ceding insurer to cover administrative expenses. Explanation: a ceding commission is a payment made by the reinsurer to the ceding insurer to compensate for administrative expenses incurred in issuing and managing policies. It is part of the reinsurance agreement and helps offset the costs of underwriting, claims handling, and other administrative activities.